Welcome back to First Trades. Let's look at what's happening in the F&O market, starting off with the Nifty futures there, where the index is down nearly 0.4%, but we're seeing flat open interest at this point in time. But there's a lot of shorts getting built because the discount is around 26 points for the Nifty futures. Nifty Bank is also seeing some similar trend there, where Nifty Bank, we have seen, the index down nearly 0.5% with a 1.27% jump in open interest there. But as we speak, there is a rollover happening from the April to the May series, so this volatility is also because of that. If you look at the constituents, there's a shorts which is getting built up in private sector banks like HDFC Bank, ICICI Bank, even SBI and Bank of Baroda is seeing some shorts. There's unwinding of positions that's happening in Kotak and IndusInd Bank there, but I think only AU Small Finance Bank and Axis is seeing some long build up at this point in time. Look at what call and put writers are doing. 24,200 is the most active one at this point in time, with a lot of action happening there between call and put writers. At this point in time, the put call ratio is more than 1, so there's a more activity of the puts happening mostly at the 24,200 level. Look at the distribution chart, and that's going to give you that there is a support which is coming at 24,200, and that's the reason why we have the index above that. But the band is between 24,000 and 24,500 for the Nifty as we speak. Future gainers include stocks which are like DRL, where there's a short covering happening. Piramal Pharma is short covering happening. Oracle is up nearly 5% in today's. That's one of the IT companies there. And there's a shorts which is getting covered. Future losers include Havel, Trent, and Ashok Leyland. There's a long unwind happening in Havels, and shorts getting built up in Trent and Ashok Leyland as we speak. Among the open interest gainers, you have stocks like Nalco, where there's a long build-up happening. Angel and Vedanta are seeing some shorts getting added there. If you look at open interest losers, again, there is going to be RVNL, where there's a shorts getting covered. DRL is seeing some short covering, and NHPC is seeing some long unwind. Among the most active stock options, you have Oracle today. Oracle Finance 9,000 April call. That's one thing, one of the most active there. That's also one of the resistance for the stock at that point in time. At that level, actually, 1.1 lakh contracts getting added. So most active stock options at this point in time there. On the put side, you have Trent, which is active. 4,400 April put is most active at this point in time. You have 53,000 odd contracts getting added in open interest position, with the premium up nearly 61 rupees to 170. So the market is at this point in time hovering around the 24,200 mark, with good action coming from the put writers. Aisha?
Right, okay, that's the take coming in on what's happening within the F&O pool right now. I mean, suffice to say that you are seeing that weakness build in definitely, and much unlike what we had up until day before. Unfortunately, it's the crude effect which has taken us down, and you are seeing that bout of profit taking in any case trickle in for our markets as well. So it seems that there is still some jitteriness on the sustainability of this move or rebound that the market has staged. And to think of it, we've already recovered almost 10% from those March lows. So that's no mean feat. And it's been a bigger move, so to speak, for both the mid as well as the small cap indexes. But Tech Mahindra, that's the one which is in focus. While the IT pack continues to reel under pressure, Tech Mahindra at least managed to deliver a strong Q4 performance, beating estimates on both revenue as well as profit. They were signaling improving execution as well. In fact, the management is saying that the company is on track to meet their FY27 commitments, which is backed by a robust deal pipeline and sustained client demand as well. Just very shortly, we'll have the CEO and MD, Mohit Joshi, to talk about the way forward for the company and what exactly does he foresee in this time of, question marks being raised on how much AI revenue is actually getting recognized and not just, an order book quotient right now for IT services. That, of course, is one such case in point, or rather one key factor that the market is extremely focused in on. But I think we can cut across. Ajit, in fact, had a conversation with the CEO and MD of Tech Mahindra, Mohit Joshi. Let's listen in.
We were very happy with the set of numbers we reported yesterday. And clearly, I think what has been most satisfying from our perspective has been the steady, consistent trajectory that we've built over the past 2 years of the transformation plan. A steady growth from a revenue perspective and a 10-quarter margin expansion trajectory, good volume from large deals. And I do see this trajectory continuing into the current year as well. I feel that over the past 2 years, we have built up the foundational strengths of Tech Mahindra. We have been able to significantly increase our win rates. We've increased our relevance across industries. We have now yesterday reported highest ever industry leading NPS scores. And this gives us the confidence that we will be able to take advantage of the opportunities that are emerging with this new AI-driven transformation for our client industries. So again, in a nutshell, we see our order book as being strong. We see a large deal pipeline as being strong. We see a huge amount of demand from our clients for AI-driven transformation and modernization. And that is really what is giving us the confidence to again recommit to growing ahead of our peers and to expanding our margins in the current year.
You know, the total order value for you for FY26 was around 3.86 billion, with $1 billion coming in the fourth quarter for you. Can you give us a sense of the kind of AI deals that are clubbed into these orders which are coming in?
Sure. So look, I think a lot of the transformational multi-year deals that we've been winning have at their foundation a significant level of productivity driven by AI. Yesterday, we also shared examples from some clients, for instance, where we're transforming the grocery shopping experience by using agentic AI. So if you as a shopper, for instance, were traditionally to go into a grocery store and you'd be looking, for instance, for recommendations for what you should cook in the evening, rather than a mere recommendation and a list, it is able to create an entire basket for you, and then you're able to check out the basket, right? We shared another example of where end user services, the service desk services had become completely touchless by the use of AI productivity. We shared examples of how we've been able to drive mainframe modernization and legacy modernization by using AI. So I think all of these examples, right, from a grocery context, from a retailer, from a logistics context, and from a energy and utilities context, are all examples of how AI is transforming the industry from a revenue perspective, from a cost perspective, and from a user experience perspective.
How are you looking at some of the verticals, manufacturing for say, or BFSI? How are they growing? And we're seeing some muted performance coming in from the healthcare and the life sciences sector. Do you see that to continue for some quarters?
Sure. So look, I think we're delighted by the performance that we've had on the manufacturing side. Manufacturing has been our fastest growing vertical last year. And this is despite the slowdown that we saw in US auto last year, right? So we were able to compensate the slowdown in US auto by the strong performance in our European auto business, by the strong performance in our aerospace and defense business, and by our presence from a process manufacturing perspective. We do see a significant trend of AI adoption, especially physical AI is very important for us, right? And if you should visit us, you will be able to see at our experience centers how we're building out the factory of the future, how we're using robotics within the plant. So that is clearly one area of growth for us. Our fastest growth was in retail CPG, which really has been depressed for a lot of our competitors. And that is because we're seen as a very strong challenger on the retail CPG side. Finally, you spoke about the healthcare business. The healthcare business did have a somewhat muted year. I think that was driven by the fact that you're seeing a lot of regulatory changes, you're seeing a lot of pricing pressure for government contracts, especially in the US. So that was a negative for us. But as we move forward into the current financial year, I'm optimistic about our ability to generate growth in the healthcare business. I don't think the healthcare business will be the fastest growing business for us, but should certainly perform better than last year's numbers.
And how's some of the geographies, especially the Americas, doing? Because that saw some, decline in revenues on a quarter-to-quarter basis as well. So do you see that coming back in FY27?
No, for sure. Look, I think our growth from a geography perspective was really driven by Europe. Part of that was obviously the strength that we've seen in our European business, the new deals that we have won, but also the currency movements, right? I mean, the Europe growth was aided by a currency tailwind. Our Americas business continues to be very strong. Like I mentioned, the Americas growth for the year was hit really by the slowdown that we saw in US auto, which is an important component of our business, and the slowdown that we saw in the high-tech businesses. We do see a strong performance in US telco, US financial services, US retail CPG, driving growth for us in FY27 as well.
From a cost point of view, we saw a significant jump in the subcontracting cost in this quarter. Any particular reason for that?
Yes, so I think, the subcontracting jump was largely driven by the fact that as we are ramping up to execute on the large deals that we have won, some of that is to prepare for that, and part of the services clearly will be provided by the use of third parties.
The net employee count also came down. So are you looking at more talent addition coming into FY27, and have you given out any offers for the next year?
Absolutely. So look, I think some of that talent fluctuation is really seasonal. For our BPS business, you do see a ramp up in Q3 as we meet retailers' expectations or end of the year volume increases for some of our clients. Like I said, we remain very optimistic about our business and about the growth possibilities for us in the current financial year. Apart from obviously hiring entry-level talent, where again we expect to be hiring more than last year, we're also hiring an incredible amount of industry expertise, right? Whether it's in financial services or manufacturing, and that should continue as well. Overall, we're optimistic about our business, and the optimism should translate into a greater hiring momentum.
How do you look at growth in FY27, Mohit? You have penciled in that you will grow better than your industry peers. Is there a target that you have set in mind for that? Because on the EBIT front, there is a target that you have already given out, and the return on equity that you want to also achieve. On the growth front, is there a target which is coming in for you?
Sure. So look, I think from an EBIT perspective and from a return on capital perspective, it is somewhat easier because a lot of the levers are within your control. Revenue is to a very great degree dependent on the macro environment as well. That is why we have shied away from giving an absolute number. But like we have said very clearly, we expect to grow faster than the average of our peers organically. And if we look at TechM, right, this is really a significant movement away where historically our growth had somewhat lagged our peers. So from lagging to leading within the scope of, 2 years is an achievement that we're very proud about.
When you spoke about the fact that growth organically, are you also looking at inorganic growth as well?
Inorganic growth, if any, will be a very small component of our growth for FY27. We have a capital allocation policy that really means that we are giving back cash to our shareholders. But also we're looking to integrate a lot of the acquisitions that had historically been done. So there probably will be some tuck-in acquisitions in the course of the year, but I don't believe it will be very significant.
And how do you look at the impact of AI on revenue deflation? Because that's one of the arguments which is playing out at this point in time. Do you see the deflation to be significant and the levers would be more on the EBIT level and the profitability level?
Yes. So look, I think this AI deflation, really this discussion has really kicked off only the past couple of days because of comments by some of our peers. Clearly, there is a productivity expectations that happens in the industry on a regular basis. And now some of the productivity expectation is underpinned by what people see as technology advances. But there's also significant revenue expansion opportunities because of AI, the modernization opportunities that we see, the transformation opportunities that we see. So I don't believe that there is one AI deflationary number. It is part of the normal productivity expectations that our industry has seen for the past many decades.
Give us a sense of how you're able to bring in your cost efficiency by using AI within the organization as well. Are you able to bring in that efficiency through AI while delivering to your clients as well?
No, absolutely. Look, I think there's a very strong expectation that we have internally and that our clients have of being able to drive productivity using AI. So let me give you a couple of examples, right? Now, clearly in the software development lifecycle itself, the use of AI platforms to deliver productivity is well known. From a contact center and from a BPS perspective, again, AI is driving significant efficiency movements. But we're also looking at at tooling and platforms that we're building on our own, like the Tech and Orion platform, for instance, that we feel will drive productivity, for us and for our clients. We're also doing an incredible amount of research work, right? So that we have the ability to build large language models from scratch. We're building specific industry use cases. We built with Google, a telco reasoning model, and the reasoning model will be able to give our telecom clients significant efficiencies from a networks perspective. So there's a huge amount of work going on in platforms, in use cases, in partnerships to drive this productivity.
Give us also a sense of how what kind of efficiencies can be brought in, or the margin expansion from 13.8 to 15%. And you have to achieve, that's what you guided for FY27. That's nearly 120 basis point jump. Where is it going to come from?
So look, I think some of that will come from the fact that we should have more operating leverage this year. We should have better growth this year than last year. As we've also shared, we believe that there is a lot of margin trapped in our fixed price programs that we hope to release by being more efficient by using AI. So I feel that these are some of the levers we'll be looking to use to drive greater margins in the current year. Our revenue mix as well is changing, right? So we are now moving more towards the higher value added services, for instance, in enterprise package implementation, in design, in data, in engineering services. And so as we change the composition of our revenue, and as we become more productive in delivering existing fixed price projects, and as we're able to grow faster, a combination of these factors should result in a margin expansion for the year.
Finally, currency has been the biggest volatility, is giving you tailwind as well. But how are you managing volatility around currency as well?
So look, I think, as we've always said, our main business is technology and business services. Currency management is a necessary thing that we have to do to safeguard ourselves from volatility. Because it has been so volatile, we have reduced the tenor of our hedges, right? So earlier we were taking 2-year hedges, and now in discussions with our audit committee and with our bankers, we have been reducing the tenor of our hedges. And so therefore, using that as a tool to protect our business without getting involved in the day-to-day volatility that we see in almost all currency pairs, right? Whether it's the rupee or the euro or the Aussie dollar, they have all been incredibly volatile this year.
Mohit, it was a pleasure talking to you today, and thank you very much for joining us today.
Thank you. Lovely to see you again.
Holding off at 24,250 levels or at this point in time, and even the Nifty IT is down 0.5%, and Nifty Bank down nearly 0.6% there. But the action is in rupee. Rupee is a little volatile at 94. It has crossed 94. It's at 94.09, and some action happening in the last 15 to 20 minutes in the rupee there. But let's look at what's happening in other companies. Unitech Aerospace zooms on the back of its acquisition of Hobel Bellows. What are the synergies for this acquisition? My colleague Karan joins us with the details.
Unitech Aerospace is in focus. The stock has delivered more than 30% returns in the past 1 month itself. With an order book of 200 crores, this company operates with an EBITDA margin of 25 to 30%. The update is that this company is set to acquire Hobel Bellows, a specialized Indian manufacturer of metallic bellows. Now, this is a crucial step in Unimech's journey to build a globally competitive, capability-led precision engineering platform. The target company operates from an approximately 1.8 lakh square feet manufacturing facility in Visakhapatnam. The target company has developed long-standing relationships with marquee OEM customers, with close to around 90% of its business being export-oriented, serving geographies such as US, UK, Singapore, and China. For the year ended 31st of March, the target company reported revenues of north of 1,020 crores. These capabilities enhance Unimec Aerospace's ability to move beyond precision machine parts and offer integrated engineered assemblies and subsystems across diversified sectors. Now, let's take a look at what kind of synergies are expected to flow in for Unimec Aerospace. This definitely gives Unimec a chance to increase its wallet share with the existing OEMs. It also enhances the financial profile as the target company brings in a high margin accretive and a cash generative business, followed by a bunch of cross-sell opportunities, capability integration, capex expansion, and operational efficiencies. On that note, do watch out for Unimec Aerospace.
Thanks, Karan, for that. Unimec is up nearly 1.3% in today's trade. Back to elections, another high-stakes battle is playing out in West Bengal with voting in 152 constituency across North Bengal and several districts in the south. The TMC in power for the last 15 years is eyeing a fourth term in the state. Since 2016 election, the BJP has emerged as one of the main contenders and opposition for the party. The party is now eyeing a victory in the state. From SIR to infiltration to women's safety, many key issues are driving the poll narrative. Ridhita Chatterjee joins us from West Bengal.
Democracy has begun in West Bengal, and this election of 2026 is going to be very crucial over 294 seats. Given to today, it is the first phase that has gone under polling. From 7 a.m. onwards, the voter turnout has been very impressive in Bengal. Of the total 152 seats that is seen today, I am here at Malda, and this is the Kalia Chowk where we are seeing outside a primary school. People have lined up in numbers to come and cast their votes, and this is what I was talking about, the number that have been very impressive to Bengal politics this time. At one side, when we see BJP is very confident about their seats, on the other side we also see that Trinamool Congress leaves no spectrum for BJP. They say that BJP is targeting Bengal. The ploy of SIR has been specially launched for Bengal, and it is to target the Bengalis, the minorities, and the women of Bengal. On the ploy that TMC has been talking about, on the other side, to defend the narrative, we have seen BJP stating that SIR is a normal constitutional process. And that is what is happening in Bengal also after 2002. However, given to the SIR crisis, we understand that Malda has surfaced over the headlines. Earlier this week, we have seen that 7 judicial officers this month was held captive in Malda, in this district, where 7 judicial officers had come to practice the SIR exercise while they were held hostage. The week entirely has seen that how Congress, ISF and MEM has been conducted to it, has been involved to it. Various leaders of them have been also arrested. However, now we see the entire situation, the narrative of the minority in Malda Kalia Chowk has been changed, as we see a very calmful voting procedure that is happening in Malda, and this is not only in Malda but all over the North Bengal and Central Bengal, which is under focus. It seems a very calm and full vote and peaceful vote all over the state. We also understand that this time Election Commission has actually deployed more than the companies that has ever come to Bengal. Extensive forces of companies have been deployed in Bengal for the first phase of 152 seats. Total number of seats that Bengal goes under polling is 294. There are also restrictions that has been stated about the 100-meter distance that will not allow any BLO or any BLA to enter the premises of the 100 meters. Media is also not allowed. People are only going to carry their voter identification card, without which they won't be allowed, and they will also not be allowed with their phones at the given time of SIR, the Bengal politics of Machli, all of this controversy and the 15 years of deprivation that BJP gives out in their chart sheet. This is a very crucial election of the 2026, given to BJP's confidence and given to TMC's not leaving a spectrum. Chief Minister Mamata Banerjee says that this time they are going to not leave a space for the BJP. However, this time we see that Home Minister Amit Shah is himself in Bengal to observe the entire elections, and he is observing it from the BJP headquarters in Kolkata for the first phase polling.
Thanks, Ridhita, for that update from West Bengal. So West Bengal and Tamil Nadu, slugging it out in this election. But Goodbye from all of us. Coming up next is Mid Cap Masala. Stay tuned.
Order wins or more news and updates or earnings. So much is happening over there. Taking a look at what the index is doing right now, the Nifty is under pressure by about 0.5%, but the broader end is looking comparatively resilient because you have the mid-cap index that's absolutely flat. Same is the case with the small cap index. So they're not seeing the kind of cuts that the Nifty is seeing right now. In fact, the small cap is holding on to a tinge of green while being absolutely flat. So while that is the state of the broad end of the market right now, let's take you through some of the top buzzers, and let's start by talking about Fujiyama Power, because a fresh buy initiation from Motilal Oswal is making Fujiyama Power soar in today's trade. The brokerage has cited strong positioning in the rooftop solar segment with aggressive capacity expansion and backward integration as key tailwinds for the company. Unimec Aerospace and Manufacturing is in focus after the company, along with its subsidiary, approved 450 crores of acquisition of Hobel Belos company. The deal will strengthen its precision manufacturing capabilities in metallic bellows and engineered assemblies. Oracle Financial Services delivered a steady revenue uptick with strong sequential growth and profitability. Revenue saw a modest roughly 5% uptick, while EBIT surged 32% with margins expanding to 51% from 40% earlier. Bharat Coking Coal, on the flip side, is under pressure after posting a weak set of Q4 earnings. BCCL reported a 5.5% of quarter-on-quarter decline in its revenue. Operating performance during the quarter was weak, with the company reporting an EBITDA loss of 335 crores versus an EBITDA of 33.6 crores quarter-on-quarter. And Tata Communications is in focus and is reacting to a mixed set of Q4 earnings. Revenue grew roughly 6% year-on-year, while EBIT rose roughly 16% with margins improving to 8.4%. However, the profit declined roughly 28% to 263 crores despite the operating improvement. All right, on to the Mid-Cap Masala show. What we are getting to see in the markets is quite a tepid session coming in for the broader end of the market as well. Yes, of course, the benchmark indices have been under pressure. Nifty trading below that 25,300 mark for itself, though there was a recovery attempt from the day's lowest point, and we are off the day's lowest point as well. But when it comes to Nifty Bank, the pressure continues. More than 400 points of cut is what we are getting to see. Sectorally, what's interesting to see is that the pharma pack is doing very well. It is the top sectoral gainer, almost a 2.5% gain is what we are getting to see. And a lot of these, the broader end participants within the pharma pack, be it the small cap or as well as the mid cap pharma companies, they are doing very well. Add to that is the Nifty Healthcare Index. That is the top sectoral index as well in terms of the gainers. Other than that, it's the power sector that is also doing very well in trade today. Add to that is the Capgut Index. So that's the health of the market right now. But let's move on and let's connect with the management. And joining us on the show is Mr. Anil Rai Gupta, Chairman and Managing Director of Havells India Limited. And Mr. Gupta, hi, morning. Good to be speaking with you. And firstly, with respect to your numbers then, when we see your EBITDA and margins specifically, they seem to be declining on a year-on-year basis. Can you tell us what is the main reason behind this and what is the outlook for FY27?
I think if we divide the results into two parts, which is Havells standalone and Lloyd. Havells, we have seen an improvement in the EBITDA margins, the operating performance, and Lloyd, there was a decline in terms of revenues and profitability. And that is also related to the fact that there was inventory in the channel due to a very bad season during the last year, and hence and a delayed onset of summer in the fourth quarter. So the revenues of Lloyd for air conditioners went down, and hence the resultant decline in EBITDA. But overall, Havells' standalone performance has been quite good, despite the fact that there were reduction in sales in seasonal products like fans and coolers. Other businesses of Havells has done very well.
Okay. And Mr. Gupta, if you could help us with what is the volume and revenue growth guidance for FY27? Any numbers if you could share?
I think right now we are still in the very start of the year, and we usually do not give any guidance. However, we do expect that there is a low base for the seasonal products, which will reflect higher volume growth in the seasonal products in this year. But there is an overhang of the war situation, which may affect the demand, but it is difficult to say at the start of the year. So we are still looking at, how this year pans out.
All right, but Mr. Gupta, let's talk about some of the factors that could be playing at this point in time, and wanted to understand how are you anticipating the cooling segment to perform going ahead in FY27? Because of late, yes, of course, the extended monsoon has something that has impacted you for the past few years, and this time around there is a risk of El Nino. Add to that, there's lots been happening geopolitically. So what's the outlook for the cooling segment going ahead?
On the positive side, yes, we are entering the year with a low base of last year. And the summer season, though it started late in April, but it has started, and it should reflect good volume growth for our seasonal products like fans and air conditioners. I think you're right. The geopolitical situation does pose some challenges, especially on the raw material prices front, which does mean that we have to pass on the costs to the consumer. And that can, be a little bit of a dampener in terms of volume growth. So, we have to balance these two things and see how things pan out in the coming quarter.
Okay. Mr. Gupta, let's talk about how situation is playing out on ground. Now, there are some reports which suggest that retailers at the moment are facing AC shortage due to a reduction in supply from manufacturers. Has there been any stalling or any delay that you're seeing in production? Any shortage over there, given the impact that we're seeing on the war front because of raw materials, LPG, gas supply? Any impact on your production, which is then leading to a shortage towards retailers?
I think this is, partly true, because right now the situation is more in the southern markets of India because of the situation where suddenly the onset of summer has happened. There were two things. One, there was some production delays in the month of March, as well as, the retailers also had stocks and they had delayed their purchases from the manufacturers. So all these things put together have resulted in a very temporary situation of stockouts, but I don't think this is something to worry about.
All right, along with that, can you tell us how much price hike have you taken across your portfolio, and especially for the Lloyd brand? And along with that, how is the channel inventory right now for fans and AC segment?
I think overall for all seasonal products, other than seasonal, non-seasonal products also are facing inflationary challenges. ACs and fans have been, seen a double impact because of the energy rating changes on the 1st of January, which meant higher costs for production. After that, there were, geopolitical changes, which also resulted in more cost increases. So between January and now, there have been constant, pass-ons to the market for cost increases. And, it's more in case of fans and air conditioners, but also in other product categories as well.
Okay, and going ahead, Mr. Gupta, if you could help us understand what is the planned capex for FY27 and for the next 2-3 years also across your segment line?
I think last couple of years we have been investing heavily on capex in cables and wires business, also Lloyd. The Lloyd side, new refrigerator facility has come up or already started production. So in the next couple of years, we don't see major capex in the Lloyd segment, but there will be continued capex in the coming years for cables and wires. And this year, we should be looking at about 1,400 crore capex in FY27.
All right, but going forward, what is the growth for the solar segment that you are expecting?
Yeah, I think, new segments like solar have contributed to good growth in the coming time. Last year, we had invested in Goldie Solar, which meant almost like setting up a factory for solar panels. So it puts us in a strong supply chain situation for solar products. So going forward, I think in the next 2 years, yes, this will be a good growth driver for Havells.
Okay, and lastly, Mr. Gupta, I know I asked you this earlier, but because of the West Asia conflict, what are the disruptions that you're seeing in your business? What is the export exposure that you have to the Middle East? Any slowdown over there?
Well, I think overall, our Middle East contributes to about 40% of the overall exports, but our exports are limited to about 5 to 6% of the overall revenues. Having said that, there are other disruptions, including, as I already mentioned, increase in raw material prices, some constrained supplies of gas and raw materials. So I think this is a challenging time through which we are navigating and hopefully come out stronger.
Indeed, and wishing you all the very best for that. But with this, Mr. Gupta, we let you go. So good having you on the channel today. Thank you so much for your time. So that was the management of Havells India talking to us about the growth outlook going ahead. They are positive in the near term, but yes, a lot of moving part when it comes to the outlook for FY27. But let's move on and let's put the spotlight on BEL, because BEL has kicked off FY27 with a fresh order win worth 569 crore rupees, marking the company's first order for this new financial year. Let me take it across to my colleague Karan, who's standing by with more details. Karan.
Defense sector major Bharat Electronics Limited is back in focus. The stock is in focus on the back of its first order win for FY27. The value of the order is 569 crores, and on that note, the company's order book stands north of 74,500 crores. With a trailing 12-month revenue of 26,000 crores, the book-to-bill comes to around 2.8 times the trailing 12-month revenue. Remember, the company had recently released its annual FY26 update, wherein it was inferred that the company has overachieved its order inflow guidance for FY26 by 11%, with more than 30,000 crore worth of new orders in FY26 itself. The stock has delivered more than 46% returns in the past 1 year, and the company has an EBITDA margin close to around 28 to 29%. So do watch out for Bharat Electronics Limited.
Okay, so that's on BEL. Thanks, Karan, for all of those details and the latest order win for the stock. Although, given the way the market is reacting, the stock is also not showing too much excitement on the back of this positive news. But the other pocket of the market where we are very surprised to see what's happening is trend, because despite an all-round beat coming in with revenue in line, you're seeing a massive cut on the stock, 3% lower right now. Let's listen into what Jignanshu Gore of Bernstein had to say on trend. We spoke with him earlier in the day, and here's what he's penciling in for the quarters to come for trend. Listen in.
West side has done better than Zudio, and hence your gross margins have been better this year versus last year. That better West side story allows you to have better gross margins, which sort of have trickled down all through. But when you look at a more fundamental metric, right, revenue per square feet, it is lower YOY, and that tells you what Sajid was mentioning, that we don't expect the margins to improve from here. Even if they are able to sustain it here, it will be a very positive for the stock. On the way we think about expansion in the Indian context is ROCE constant, but value per store does not go up, right? Or it's not better in a smaller town. So when a company goes from a large city to a small city, they have lesser revenue per square feet, but they also have lesser costs per square feet. That's how we think about it, that revenue per store does go down, and hence the value of each incremental store will go down, but so will the capex. When does the expansion stop? We think there is still a lot of headroom for growth. The advantage for Zudio is its pricing structure and its cost structure allows it to run on relatively thinner margins in apparel than most of the other branded large players. See, we think that a 20% growth stock will get anywhere between around 60 to 65 multiple, right? And that's the benchmark that we go with, which is why we think a fair price for this over the next 12-month period is around 5,000 rupees from the current value of 4,400, 4,500.
All right, so that's about trend, but let's move on and let's talk about Godrej Industries, as the company is sharpening its growth strategy with a clear focus on premiumization, capital efficiency, and scale expansion. Management expects profit growth to exceed 20% with a target ROE of 18% across businesses. The real estate arm continues to lead with strong launch pipelines and significant monetization potential from the Vikhroli land parcel. Sajid caught up with Executive Chairperson Feroz Shah Godrej on their expansion plans. Here's an excerpt.
Well, very excited here today to be announcing both a new purpose for the group, set out a 5-year ambition for the group, as well as you rightly pointed out, of identifying a new brand identity. We have the interesting position in the group now of both being a 129-year-old business in some ways, since the Godrej Group was founded in 1897, but also just a 2-year-old group in the format of Godrej Industries Group. So what we wanted to do was celebrate the best of our past, make sure that we're celebrating things like the Godrej Signature, which is an iconic brand known by every Indian, but also update our brand positioning, make sure that Godrej Industries Group also has a distinctive branding. So what we've done is, if you see, have the Godrej Signature on the one hand, which will continue to be our consumer-facing brand, which will be what we put on all consumer-facing communications, but also have a business-focused brand and a new way of writing all of our companies' names, which is the Godrej Industries with the new GI symbol. And both of these will be used simultaneously to both celebrate our past and legacy with this iconic brand that is so well known, but also have a distinctive identity for the Godrej Industries Group.
I was looking at your release, and one thing struck me very clearly was that the next generation is very aggressive on growth and return on equity, which basically the shareholder wealth creation. Am I right in assuming that?
Well, look, I think, it's incumbent on us to, of course, dream big for the future. I think we inherit a tremendous opportunity and incredible legacy of strength. Already, if you look at the last 5 years, the Godrej Industries Group has 6 operating businesses under it. Cumulatively, over the last 5 years, they've compounded sales at over 20% and also earnings, profit after tax also at over 20%. So I think we have a great foundation, lots of opportunities ahead. So certainly we would like to continue to grow fast. We intend to continue to grow profits at over 20% a year. And as you rightly pointed out, what's very important is not just growth, but making sure that that growth is delivered very efficiently from a capital perspective. So we've also set each of our businesses a minimum target of achieving a return on equity of 18% over these next 5 years.
And what will that entail in terms of investments going forward, and whether it will also mean that going global as well for you?
I think this question is more of a business-by-business question. There are some businesses that are already quite global and will continue to look at global opportunities, such as Godrej Consumer Products, our FMCG business, which has nearly half of its sales outside India already. So that business does see a lot of global opportunities. On the other hand, we have some businesses that are very focused on the opportunity here in India. So Godrej Properties, for example, despite being the largest developer in the country now for 3 consecutive years, has a market share that's only about 5%. So we see huge growth opportunities by taking that market share up. And our aspiration over the next 5-6 years is to double the market share, as we've been able to do over the last 5 years. In terms of investment, again, it's a little bit of a business-by-business question. For the listed businesses, they will take care of their own investment requirements. For our unlisted businesses, of course, the group will support them until they access public markets themselves.
From an operating vertical point of view, 3 companies are listed. If you look at in total, around 4 or 5 companies are listed, including the holding companies listed there. But you plan to list more companies coming in. So which are the verticals which may go first for listing?
Well, I think, we're not expecting any new public listings in the next 1 or 2 years. But over this 5-year period, we think there's an opportunity to list at least 2 more businesses. I expect one of them will be our financial services venture. We're very happy with the progress in that business. It's the group's youngest business, still only 5 years old, but already has achieved an AUM of about 25,000 crore. We expect over this 5-year period to get to about 100,000 crore. And that we think is a good scale for taking that business public. And we may also look at listing Godrej Chemicals, our chemicals venture, and also potentially Godrej Ventures.
Interesting. You spoke about capital, and it's. I think financial services is the way to go because every group is now looking at how to expand financial services and enter into secured and unsecured loan market. How do you see the pathway for financial services as you speak? Because you're putting yourself at 100,000 crores AUM in the next 5 years. It's from 25, so it's almost 4-fold increase in AUM for you.
Yeah, I think the opportunity is huge, right? I think financial services typically in many countries and certainly here in India is one of the biggest sectors of the economy, one of the most important sectors of the economy to facilitate liquidity for customers, for businesses that seek capital for growth. So we think it is a very important part of the overall Indian economy. Godrej Capital, since it is a young business, it still has a very modest market share. So the growth opportunity is very strong. These might sound like very high growth rates, but given the kind of momentum the business already has, given the size of prize of the financial services industry, we're quite confident about being able to get there.
You've set yourself a target of 5 lakh crores in market cap. The current group's market cap for listed companies is around 2 lakh odd crores. That's almost doubling in next 5 years for you. Where is the growth going to come in? Is it from the financial services as and when that list, or is it the existing businesses which will contribute? Godrej Consumer, which is more than 1 lakh crore in market cap today, and maybe Godrej Properties.
Yeah, as we looked at it from the end of March numbers to March FY31, which is the 5-year period we're looking at, this actually involves a faster growth rate, about 2.5 times the size is what we need to grow to at about a compounded growth of 23%. I think it will be a combination of value creation through some of these newer businesses getting publicly listed and creating value through that. But a lot of the growth certainly is expected from our existing large listed businesses like Godrej Properties, like Godrej Consumer Products, and Godrej Agrovet, all of which we see have tremendous opportunities, both for operational improvements, operational growth being very strong over the next few years, as well as hopefully the market recognizing that value creation.
You were one of the few to go global with respect to your consumer care business, consumer products business there. Do you think there's a huge runway for consumer products globally? Even though it's contributing, international business contributes nearly half of your business now.
Yeah, I think it's an exciting opportunity. I think the primary focus of the business, though, frankly, is India. We see the Indian economy itself is likely to grow so much. There are so many new FMCG categories that we can enter. So, for example, just in the last 2 years, we've had many success stories in terms of both organic and inorganic growth. On the organic growth side, we entered the liquid detergents market through a brand called Godrej Fab, which has quite quickly scaled in just 2 years from 0 to almost 400 crores, making it perhaps one of the fastest home care brands in the country. We have a lot of investments in our R&D facilities and our capabilities there. We hope to enter new categories within FMCG organically. We've also made some interesting inorganic acquisitions. Just a few months ago, we announced the acquisition of a small company called Mushtaq, which is the number 2 player in the men's face wash category, and hope to bring their very innovative digital marketing capabilities, combine it with the strength of GCPL's distribution, and see a lot of strong success there. So I think there's huge opportunities for organic and inorganic growth in India. But as you rightly said, in a category like FMCG, we think Godrej Consumer Products does have some distinctive capabilities, some brands that are potential, very strong potential for success in international markets. So we will be investing behind those. And of course, we also have a strong presence in international geographies like Indonesia and Africa already. So we hope to see those businesses grow a lot as well.
As far as properties is concerned, you're sitting on a gross, with a total GOV of nearly roughly around, if I'm not wrong, 1.35 lakh crores as of today. And that's excluding Vikhroli. What is the kind of path for Godrej Properties? And if you can also give us a sense of the kind of development that Vikhroli will bring in, or the value creation that Vikhroli will bring in for your group.
Yeah. No, it's an extremely exciting opportunity ahead for Godrej Properties. As I mentioned, for the last 3 years, Godrej Properties has been the largest real estate developer in the country by sales. But despite that, its market share is only 5%. It's doubled over the last 5 years from just under 2.5% to 5%. But we think that being a market leader with a 5% market share implies a strong runway and headroom for growth. And one of the things we're very happy about with Godrej Properties' recent performance is that its growth has been quite well distributed across geographies. So if you look at it, Godrej Properties last year amongst listed real estate developers was either the number 1 or the number 2 player in each of the country's 5 largest real estate markets of Mumbai, NCR, Bangalore, Hyderabad and Pune. So we think there's tremendous opportunity to continue building on that growth momentum.
Okay, that's the word coming in from Piroj Shah Godrej of Godrej Industries in terms of what the group's plans are. And the key takeaway is that they're looking to list Godrej Chemicals in the near future as well. So while that's on Godrej Industries, the stock is up 7% on the back of very positive commentary coming in from the management. But shifting focus and talking about yet another stock that's doing really well, and that's Fujiyama Power. That stock is up between 8 and 9% as we speak. This was also the big bold brokerage call of the day on ET Now earlier in the day, where we highlighted that the reason why the stock is buzzing so much, a 9% uptick on that stock, is on the back of a fresh buy initiation coming in from Motilal Oswal with target price of 340 rupees, which is still a 30% upside to where the stock is trading right now. The company is an integrated B2C solar rooftop solutions provider offering inverters, solar panels, batteries, chargers and solar management systems. They've scaled the capacity of their solar panels, batteries and power electronics to more than 1.5 gigawatt each as of December of last year. The company is expanding to tap into India's 100 gigawatt solar rooftop opportunity. And this is going to be a key positive for the company. They've already planned 300 crore capex for panels, inverters and batteries, which could take their capacity to 3.8 gigawatts in the near future, is what Motilal believes. Lastly, they say that they expect this company to deliver strong growth of 56% in the near term, and they value it at 15 times FY28 EPS. But on that note, we're completely timed out on this edition of Midcap Masala. From everyone who put this show together, thanks so much for tuning in. But stay on, because Buy Now Sell Now is up next.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
साथी हाथ बढ़ाना साथी रे जिंदल साथी दिल साथी रे